I'd like to introduce our first speaker, Kevin Dent. Now, Kevin is the Senior Manager of the Superannuation Branch and the Industry Technical Services Unit of APRA. He's been with APRA since 2004. Please welcome Kevin Dent.
Thank you, Troy. What I'd like to do today is talk about a recent APRA publication. I won't trouble you with a presentation. The publication is called Liquidity Management in Superannuation, and it's on the APRA website, and it got a little bit of media coverage about 3 or 4 weeks ago when it was released. I'd recommend it to you as a source document for, I guess, APRA's views on liquidity management at the current time. The publication actually takes into account 3 sources of information. One was a liquidity survey which APRA conducted in mid-2008. The second source of information is APRA's experience in managing frozen funds and illiquid investment options during the GFC. There are about 52 funds, I think, which sought relief under the portability rules, usually in respect of a specific investment option or a number of investment options in the fund. The final source of information in the article is APRA's own supervisory experience in dealing with trustees over the course of the GFC in terms of their evolving practices with liquidity management. So if I can start with the survey, as I said, this was conducted in mid-2008. It actually followed a talk which Ramani Venkatramani gave at the CMFSF seminar conference in March 2008. He spoke on liquidity. Ramani's talk was designed to raise awareness in the industry about the issue. It was the beginning of the volatility. It wasn't the worst, the period was the beginning of the volatility, but it wasn't the worst aspects of the GFC, but the instability in the debt markets was becoming more obvious. APRA was also, I think, as a consequence of its general supervision, was aware that many trustees were investing larger proportions of the funds in illiquid assets, unlisted assets and more complex assets. We're also conscious that choice of fund had come in 2004, but it got quite a fillip with the change in 2007, which brought the portability rule down from 90 days to 30 days. So that had only been in place for less than a year. When that change was made, there are also other changes made to the SIS legislation to allow trustees a little more flexibility in their treatment of illiquid assets in terms of member redemptions. The survey was which followed Ramani's talk at CMSF. Part of the reason for doing the survey was to get a better understanding of how trustees were actually implementing those changes to the portability rules and the impact on liquidity policies and practices. I think, I suppose to summarise the general problem, you have an industry with long-term reasonably predictable cash flows as an industry as a whole. It's a unique industry in having a compulsion on employers to contribute to their employees' superannuation, and you couple that with mandatory preservation. So the system as a whole is actually quite robust, but at the individual participant level, which is the individual fund level, it's not necessarily stable because the inflows and outflows which you see at a system-wide level are not necessarily at all mirrored in an identical way for the individual funds. So the survey was to flush out what the actual practices were of individual trustees. Now, I suppose in general terms, what it demonstrated was that by and large trustees had a good understanding of their obligations in terms of liquidity management and the SIS requirements, and most trustees incorporated liquidity as an explicit risk in their risk management. In the order of 90% of those documents had an explicit reference to it. Usually the most common controls were monitoring of cash flows and often for the purpose of rebalancing investment options or managing cash flows for investment purposes. Some funds also undertook annual budgeting of cash flows. About a third of funds said that they undertook scenario analysis or stress testing for liquidity. When we drilled down more closely as to what was actually going on with funds that responded positively to that question, in fact, what they were really doing was much more monitoring and rebalancing rather than stressing the portfolios. It was perhaps a confusion of terms on their part. So when you looked at, and this is mid-2008, so this is the experience a couple of years ago, only about 6% of trustees, which is about 1 in 16 trustees, actually used stress testing as a liquidity management tool. So if we look at the learnings from the survey, and a lot of these I think will have already been incorporated by trustees, given that we're, as I said, talking about their responses prior to the worst of the GFC. The first lesson, I think, is to avoid an over-reliance on historical cash flows as the main control for liquidity management. As I mentioned earlier, the system as a whole has a lot of money coming into it. There's about 70-odd billion of employer contributions and about 40 billion of benefits. So there's a net 30 billion coming into the system each year. But that plays out quite differently for individual funds. And I think it's important when you're running a fund, a trustee or investment managers, to focus on the actual experience of the fund rather than the experience of the system as a whole. Also, when you're looking at the fund, concentrate at the investment option level. A lot of the responses were whole of fund type responses, looking at in particular I suppose the experience of the default option in the fund. I think it's important to understand liquidity at the investment option level, at every option level, because when you look at what happened during the GFC, it was options which failed rather than funds. And when I say failed, I mean that they weren't able to manage the anticipated demand for redemptions, sometimes because what had previously been a liquid asset became illiquid, and sometimes because what were inherently illiquid assets from the start, the environment which saw low redemptions increased to higher redemptions, those options, property type options, were unable to sustain that. I think when you look at options as well, it's also very important to understand the interaction between default options and other options where the default provides liquidity support for other options. In other words, when there's a general rebalancing which occurs such that the non-default options more or less keep to their strategies and the default option picks up the effect of investment switching and other transactions. Now, that is something which is not uncommon, particularly in industry funds, but it is something which does have to be monitored quite closely in terms of the percentage of the fund which the default option represents, and also the impact on the members of the default option if there's a lot of activity in the other options which is flowing through. The third lesson, I think, is to understand the membership, and the membership is really the liability structure of the fund. The new accounting standard, whenever it comes in, will treat member benefits as a liability. So funds will go from having very large net assets to virtually no net assets, or net assets equal to reserves, and that'll be because member entitlements will be explicitly recognised as a liability. But trustees should have a good understanding of the membership, and probably the most significant aspect is that account numbers do not equal assets. As the people mentioned earlier in the earlier session, there are 32 million accounts in the system. A lot of those accounts are low balance accounts. There's a much smaller number of high balance accounts which can have a much more significant impact on the actual liquidity of a fund. And here we're really talking about the 80-20 rule and the extent to which it plays out in the fund. And it can be quite significant even in multi-employer industry funds. And I'll give you two examples. One fund which had 2% of the membership account for 20% of the assets, and 10% of the membership account for 50% of the assets. Another fund, 5% of the members account for 35% of the assets, and 25% of the members account for 3/4 of the assets. So it can be quite significant, and I think that appreciation of where the concentrations of assets are amongst the membership and the behaviour of people in the fund. I've seen some quite good financial condition reports which follow member activity over time to work out what is actually going on within the fund with particular members. And I think the membership is quite important. If you think also that a lot of funds have growth strategies, it's quite common that funds that do want to stay around want to grow. And one of the common methods of growing is to try and enlarge the scope of membership. And one of the ways of doing that is to become public offer if you've not already public offer. In the branch that I look after, we've varied 4 industry fund licences in the last 2 or 3 months to allow them to become public offer. And public offer membership introduces another variable. Public offer are certainly not the only high balance members, and they're not necessarily high balance members. But if you do develop growth strategies which are dependent on bringing higher balance members into the fund, then you also need to have regard to what can happen if those people leave the fund. And the distribution, there's an APRA publication, annual bulletin, which summarises the returns that all funds produce, and that shows that about a third of assets are controlled by members above 60, about a third of assets are controlled by members, or I should say vested benefits, which is slightly different to assets because we've got some semi-funded schemes, but a third of the vested benefits are for people over 60, a third are in that group 50 to 60, and about a third are the under 50. So there's quite a skewing towards the older age group, which means that those high balance members can become quite significant if they become disaffected with the strategy they're in, or disaffected with the fund, or confused, or uncertain, or risk averse, and they decide to either swap within the fund or swap out of the fund. The next lesson is to supplement the ongoing monitoring and cash flow budgeting with scenario analysis. And I think Greg and Sam will talk about this in more detail, but from our point of view, what scenario analysis does is demonstrate that the trustee is actually trying to build and maintain quite robust products or options within the fund, options which can withstand adverse events. And with scenario testing, you're deliberately, if you like, shocking the fund or the option to see what will happen when things deteriorate, and deteriorate markedly. And the purpose of doing that is to find out what will cause us a problem, and consequently what, if anything, do we need to do to change. We don't see scenario analysis as a form of compliance. In other words, it's not something that you do to demonstrate that what you've already decided to do works, and therefore you can relax. So I think if you do scenario testing, really what you're trying to do is to learn the limitations of your understanding and the limitations of the current structure of the fund, so that it feeds into the next iteration of design. One of the things that with scenario analysis as well, which came through in the survey, is to work out at what point options will fall over where you need to suspend transacting and get portability relief. One of the areas of interest in the survey was we asked trustees, hypothetically, assuming no operational constraints on the processing capacity for benefits, how much of an option would you allow to be redeemed before you'd call a halt? And what a number of trustees responded, and I think it depends on the perhaps who answered the question, but a number of trustees worked out the answer that if there was X% of the option was illiquid, then 100 minus X% of the option was the amount that could be redeemed. And clearly that doesn't give any regard to what the residual effect on the effect on the residual members of their asset allocation. Scenario testing can help you formulate views about that point at which you decide or should decide that the option is no longer able to operate under normal terms. In conclusion, I'd recommend, as I said, the article for a full set out of more detailed information on the survey and our expectations and guidance. There's also other good guidance from some of the industry bodies. ASFA has put out 2 good papers on liquidity management. And the final point I would make is that even though we appear to have got through the GFC, this is not an area that you can solve on a permanent basis. It requires ongoing attention, and it's one that we would strongly recommend that funds not become complacent about. So thank you.
I'd like to introduce our second speaker, who is Greg Nolan from Care Super.
Thanks, Troy, and good morning. It should be an interesting session this morning because a lot of what Kevin said I will gloss over. We in fact do a lot of what APRA has suggested, despite the reservations that APRA seemingly has. So it'll be interesting to pick up a lot of these points in question time. Care Super has no strategy forced on them as a result of liquidity constraints. They've thus never been forced to be a distressed seller or a forced seller in illiquid markets. And I think this is the crux behind having enough liquidity in your portfolio. This is one of the primary risks that you've got to guard against, being forced to go to the market to become a price taker rather than a price maker. The fund did identify liquidity as a risk, and as a result has always managed its liquidity and has been able to navigate some of the difficult times over the past few years without any major issues coming to the fore. In the brief time I've got, I wanted to just really address what I think are 5 key questions regarding liquidity. And I'll warn you now, I'm pretty bland, I'm a pretty conservative sort of person, so this is not going to be anything controversial, I don't think. But you wait till Sam gets up here, and he's the one. He's the one who really will start to get you thinking. But firstly, the first question is, what is liquidity risk? We've defined it in our policy statement as a failure of controls associated with ensuring adequate cash flows to meet all financial commitments in a timely manner. For example, it's a failure to meet benefit payments and other expenses, and importantly, I think, a failure to maximise investment opportunities through inadequate cash flow management and the switching pattern of members. So you don't want the tail wagging the dog, if you like. You don't want to be in a position where there's a great opportunity and you just can't avail yourself of that opportunity because you haven't got the money in the bank. It was recognised that liquidity needs will vary depending on the age membership, and Kevin's spoken about this. The age of membership, the growth rate, the tendency of members to switch, the market conditions and your asset allocation at that particular point in time. And the key aspect of that is that really one size does not fit all. It depends very, very much on your own particular situation as to what sort of liquidity you need around you. Liquidity is different from the fund's net asset position or its solvency. You can have positive net assets, but must be able to convert those assets quickly to cash without affecting the market price to be considered to be in a liquid position. In our risk management statement, we rate liquidity risk as 2 in terms of likelihood. So it's sort of possible, but not probable. That's 2 on a scale of 1 to 5. But we do rate it as a major issue if it did come to the fore, and therefore we rate it 4 in a scale of 1 to 5 as a consequence. So it is a significant issue that we do think about, and we do think about it regularly. Why do we need to manage liquidity? Well, the obvious answer to that is to be able to process any benefit payments that do come in. But there are other reasons, and Kevin sort of alluded to a lot of or some of these, but I'll just run through them in any case. It's really to provide for any unforeseen contingencies, such as a large member leaving that might cause a lot of redemptions or a run on the fund, and I know Sam will talk more and more about that after. I guess they're the two obvious reasons, but also to give us the cash to take advantage of any opportunities, to give us the flexibility so that we're not in a forced selling position. I've mentioned that before. But I think importantly and APRA does talk a lot about this, but to ensure equity between members. If you're in a market and you have to sell, or you become a price taker, for the members who are left in the fund, they may be treated inequitably. So I think that's an important issue. We have to treat all members equitably and fairly. Also got to manage large devaluation of assets, and we all went through that with the depreciation of the currency a couple of years ago. We've got to protect against managers freezing, and that, an incident was brought to mind when I was preparing this. I was with a fund manager probably now 10 years ago, and their property allocation froze. So we were in fact in a position where that was the days of balance funds, when clients, when they were redeeming units, we gave them actually property units. We couldn't give them cash. So this is an issue that is not spoken about a lot, and it's probably not going to happen, but it just may happen, and I'll just draw that to your attention. And a final reason is also to accommodate switching within the fund. APRA makes a very good point about managing liquidity, and they say that if you do have a liquidity problem, it's not only going to affect your members adversely, but it may lead to a loss of confidence in the system as a whole, and I think that's very important. We're only as strong as our weakest link, and it doesn't do any of us any good if any fund has any of these issues. So there needs to be a balance between having enough liquidity to satisfy cash requirements of the fund, as well as taking advantage of any attractive investment opportunities that may not offer immediate liquidity. And there's this mismatch that Kevin did speak of, that's a bit of a juxtaposition, if you like, where we've got the people can leave within 30 days, but then we're actually investing for 20 or 30 years. So that's an obvious contradiction there that we've got to be monitoring, and must have enough liquidity to satisfy those who want to leave. Having listed all these reasons, I would suspect that the more likely event, or the more likely liquidity event, will occur as a result of a bad investment rather than anything else. How do we monitor liquidity? Well, Kevin's spoken about these things. We do actually monitor cash flows, and we monitor them out 12 months. We do regular stress testing, we do scenario analysis, and we actually do test the portfolio and test some of the options to see how they do react under various adverse market conditions. And we report to the board on this on a monthly basis, so the board can see in front of them if a particular scenario occurred, such as the dollar might devalue 20% and at the same time equities might fall 15 or 20%, just how that affects our balanced option and how that filters through to the asset allocation that we do have at that particular point in time. We also manage liquidity via member communication and education. We think this is a really important point, that if we can educate members that they're invested for the long term and that any particular short-term sentiment shouldn't affect their strategy, we think that will go a long way towards mitigating against any liquidity issues that might come about as a result of switching, or in fact leaving the fund and going elsewhere. We also thirdly have a liquidity policy in place which does define the limits upon which we do operate. How do we manage liquidity? Well, I think that some of the management techniques are inherent and innate in the fund, if you like. We do have a diverse employer base. We have about 30,000 employers. We have a very diverse member base, and the age and geography of that is very important, as has been mentioned before. About 80% of our members are under 51, so we're obviously not going to be faced in the next 2 or 3 years with a lot of members retiring and transitioning to the pension. So that's a natural hedge, if you like, if I can put it that way. We also have a natural hedge in the diversification of the fund in terms of asset classes and managers. So that's a mitigator against any liquidity constraint that any one asset class or any one manager might bring about. We also do use our default option as a banker, which does provide liquidity for the other options, and we've considered equity issues around that, and we consider it to be not significant, and perhaps we might want to talk about that through question time. One of our key tools, if you like, is we do have an asset allocation overlay, so that if markets do fall in any one asset class, or rather in just the listed asset classes, I beg your pardon, we do, via derivatives, rebalance back to our benchmark or bench to our target asset allocation. So again, it's about not being forced into the market to be a buyer or a seller at any particular price, because that's the last thing we want to do. And finally, of course, which Kevin's mentioned, we do have significant net inflows, and most of the funds here would have that in their own cases. What does liquidity cost? I think it's a bit hard to measure, because you're invariably talking about opportunity cost. You're invariably talking about the cost of not doing something. Sometimes, however, it can cost nothing. Sometimes being in cash is a really good investment, because obviously if equity markets are falling and you're in cash, at least you're earning a positive rate of interest. So sometimes having liquidity can be a good thing. On the other hand, sometimes it can be very risky and very expensive. Obviously, if the converse holds, if equity markets are rallying strongly and you're in cash, it might not be a particularly good thing to do. One lesson I think we've learnt, though, over the last 2 or 3 years, or one lesson I've learned over the last 2 or 3 years, is that you should be paid for liquidity. We have the money, it's our members' money. If we're going to invest in illiquid assets, we should be paid handsomely for doing that. And I just think that maybe over the last, leading up to the GFC, maybe we didn't appreciate that point as much as we perhaps should have, and going forward I suspect that we will be asking for higher earnings on illiquid investments, and I'd encourage that. Just finally, dot points on what Cooper says. We were asked to comment on Cooper as well, and I guess this is something that we'll may have to consider after this afternoon. Hopefully we will. But he said liquidity needs should be considered in all RMPs, or risk management policies. They should be considered at the option level, not simply the fund level, and Kevin alluded to that also. Liquidity is more important at the retirement phase, so as funds mature, it becomes more of an issue. And there is this mismatch between the 30-day portability rule and long-term objectives, which we were aware of and have spoken of. And I just reiterate, if one fund suffers a liquidity issue, it could rub off on us all, so it's really important for us all to consider.
Thanks very much, Greg. Let me introduce our last speaker now, Sam Cecilia. Sam's the CIO at Host Plus, the national super fund serving hospitality, tourism, recreation, sport and related industries. Please welcome Sam Cecilia.
Thanks, Troy, and thanks, Greg. I was writing in something controversial during your talk. The events of 2008 and 2009 certainly provided a stern test to the way superannuation funds manage their liquidity. For Host Plus, in contrast to many other funds, that test did not arise from members moving to a cash member investment choice option. Less than 3% of Host Plus members moved to cash during the GFC, largely attributed to the fund's member demographics having a relatively low average age of around 27 years old. Of course, it's now common knowledge that for some other funds with a higher average member age, 30% or more of member funds moved to cash over the same period. So the fact that superannuation funds withstood such a stern test during which included both of these outcomes, 3% for Host Plus, 30% for some others, and yet both of those funds survived, is testament to the resilience of the Australian superannuation system. It demonstrates how Australian superannuation funds, benefit from mandatory SG contributions. And that benefit suggests that superannuation funds, to varying degrees, ought to have a natural tolerance for illiquidity. Now, I'll come back to this point at the end of the presentation, because it seems to me that superannuation funds are unnecessarily hamstrung in their ability to take on additional levels of illiquidity, especially given the fact that superannuation money is locked within the superannuation system. Members cannot take their money. They can move it, but they can't take it out of the superannuation system until they reach retirement age or die, with very few exceptions. Now, I take enormous comfort with the fact that Host Plus emerged largely unscathed from the global financial crisis. It's not to say that we didn't learn any lessons along the way. We certainly did. Nevertheless, what the GFC did is it afforded us an opportunity to refine the way we approach liquidity management. And what we did is we refined our processes by, the first thing we did simplistically is we segmented the cash inflows that we received into 3 buckets. We now have an illiquid cash bucket. So cash is not cash, right? We have illiquid cash available to the fund, and that is cash that needs to serve existing commitments. So you can't use that money for new investments. We have contingency cash to take into account, for example, the need to pay tax or to roll over a currency contract. Remember, during 2008, that period where the Australian dollar fell 30-odd% relative to the US dollar was very painful for some funds. And then the third bucket is we have liquid cash, and that's cash that we can use for new investments. And that was, one modification that we undertook during the GFC. We also introduced more stringent stress testing of the fund's liquidity levels, which of course showed pretty, an incredible robustness due to the fund's demographics and our strong net cash inflows. What stress testing our liquidity did is it permitted the fund to set a comfortable upper limit on the level of illiquidity of 40% of fund assets. Now, I'll reiterate this. I'm very careful in saying that 40% illiquidity represents a comfortable upper limit. The fund can easily tolerate, as a result of our stress testing, we can easily tolerate far greater levels of illiquidity, well in excess of 50 or 60%. And we may need to move into that territory to take advantage in exceptional circumstances in the event of, an excess of illiquid assets that may become available for the fund to move in. But at this stage, we have set a comfortable upper limit of 40%. Now, at Host Plus, we define an illiquid asset as an asset that is not able to be redeemed at a fair price within 90 days. Now, this definition is appropriate for Host Plus, given our, particularly strong net cash inflows. All superannuation funds should consider defining what they consider to be an illiquid asset, taking into account, as Kevin pointed out, that in times of market stress, assets behave differently. The illiquidity of assets, of course, poses a number of problems for any super fund, including Host Plus. Primarily, if it results in the fund being unable to meet its obligations, member redemptions, for example, tax, fund obligations, and investment obligations, such as foreign exchange commitments or drawdowns as called by unlisted managers. However, there's also a secondary issue which I think we shouldn't ignore, and it is very, very critical in the period ahead, and that is, as Greg has alluded to, there's this issue of opportunity costs if the commitments that we have made, and in other words, the assets that we've tied up in an illiquid form, come at the expense of being able to better utilise those funds for more lucrative purposes, and that is a situation that some funds also experienced during the GFC. Nevertheless, at Host Plus, we wanted to ensure that irrespective of the circumstances, our fund should never approach a 100% illiquidity ratio. In practice, we wanted to have a relatively large safety margin implicit in our fund structure, so that even under the most extreme circumstances, a reasonable safety buffer of liquidity exists. Today, Host Plus's actual level of illiquidity is 38%. Please note that the ratings agencies produce asset allocation surveys, actual asset allocation surveys, not strategic asset allocation surveys, right? And the actual allocation surveys tend to underestimate the actual levels of illiquidity, because all the ratings agencies do is sum the actual allocation that you have in your super fund across 3 unlisted asset classes: direct property, private equity and infrastructure. But recall, Host Plus, we define an illiquid asset as an asset that's not able to be redeemed at a fair price within 90 days. By our stronger definition, there are assets outside of direct property, private equity and infrastructure that are deemed effectively illiquid. And this differential can be material. At the last survey in December 2009, the ratings agencies reported Host Plus's illiquidity to be 28%. It's actually 38% by our stronger definition. The purpose of stress testing our fund's liquidity aims to answer one question, and that is, what level of illiquidity can the fund reasonably tolerate? And so what we did is we developed a scenario-based approach to stress testing. We used 4 scenarios, each of which severely tested the liquidity of the fund. And then we compounded those effects so that scenario 2 assumes scenario 1, and scenario 3 assumes both scenario 2 and scenario 1, etc. The 4 scenarios are as follows. The first scenario, we assume that 30% of the fund's assets are immediately redeemed or moved. Remember, in the GFC, the worst crisis the superannuation system has had to endure, the most that moved in any of the funds that we're aware of out there is around 30%. So we assume that that happens to Host Plus. Second scenario, we assume that the fund's earnings, our investment earnings, drop to 0 over a 7-year period. That's a pretty significant stress test. The third scenario is that we assume that the contributions to the fund drop to 0. That's a really severe stress test. And the fourth scenario, we assume that all of our unlisted managers to whom we've made commitments instantly call all of those commitments. And then we compound those scenarios so that they occur together. And for Host Plus, the fund never becomes fully illiquid, even in this perfect storm where each of those scenarios are compounded. Now, given that few of those scenarios are likely on their own, let alone all occurring simultaneously, and we believe that the trustees' decision to set a 40% upper limit of the fund's illiquidity does not pose a material risk to the longevity of the fund. It represents a line in the sand, if you like. In any case, in reality, we would have several years to adjust to change scenarios, and we've also assumed as part of the scenario testing that we cannot sell any of our illiquid assets, whereas in practice we know that all assets are sellable, albeit at a much reduced price. At the start of the presentation, I said that it seems to me that superannuation funds are unnecessarily hamstrung in their ability to take on additional levels of illiquidity, given that superannuation money is locked into the system. An overwhelming strength of industry funds is the ability and the willingness to cooperate together for the benefit of our members. And nowhere is this more evident than when we invest in unlisted assets together. This communal investment spirit has served us well. and it's reduced due diligence costs, it's reduced fees, it's afforded a collective of like-minded superannuation funds the ability to control term sheets and ultimately control the investments. However, like-minded is not the same as like liquid. Let's assume for a minute that your superannuation fund has reached its level of comfort with respect to exposure to illiquid assets. Question: how can we use the characteristics of the superannuation system to our benefit by collectively sharing liquidity? How can we position ourselves to benefit from the expected disposal of real assets by governments across Europe? How can we be ready and willing to participate in nation-building infrastructure projects in Australia? Overnight, President Obama announced a $50 billion infrastructure plan to rebuild 240,000 kilometres of roads in the US and 6,000 kilometres of railways. It's begun. So can you participate as a super fund, or are we going to collectively be spineless and hide behind potential member investment choice threats? But we need a solution to the problem. The problem is still there, right? So for some time now, I've been saying that superannuation funds would benefit enormously from a facility that could be used to offset temporary liquidity needs. Let's call this facility a liquidity window. We don't have a liquidity window. We should have a liquidity window. In concept, it would function like the RBA window. The Reserve Bank of Australia affords deposit-taking institutions and banks the ability to mitigate their short-term illiquidity. The availability of a liquidity window would permit superannuation funds to invest over much longer time horizons, and consequently they should be prepared to invest significantly more in illiquid assets without fearing the need to hold liquid cash just in case members decide to exercise member investment choice. This is not the forum to debate the detail of how a liquidity window mechanism would work, but conceptually it should permit member investment choice options to be backed not just by cash, but by future compulsory superannuation guarantee contributions, by rental income that comes from your direct property portfolio, by distribution income that comes from your infrastructure assets. I can see absolutely no reason why we have to hold liquid cash for member investment choice options. What we need to do is find mechanisms to transfer the value of the members' holdings from one option to another or between funds. It need not be by cash, and a liquidity window would help offset that. Perhaps this is a good place to stop, but as a final word, I urge superannuation funds to lobby for a liquidity window. We need that facility. You never know, you might need it one day too. Thanks.
Thanks very much, Sam. It's a good time now for audience questions. We have roving microphones available to anyone. Down the back.
Yep, David Elliott from Host Plus. Great presentation, Sam. I think we've got every unlisted manager now knocking at our front door. Question to Kevin, just in relation to some of the statements that Sam has made about this notion of trying to, I suppose, hold as little cash as possible. I think clearly one of the obstacles, or one of the key issues that most funds need to contend with, is the view of the regulator in regard to taking that type of approach. So I'd certainly be interested to hear your views and your comments about what Sam is proposing, or whether or not you believe that might be a functional way for funds to try and deal with this notion of liquidity.
I think liquid assets extend beyond cash. I think what Sam was proposing is something far more radical in terms of the transferability of non-cash assets between funds, some access to future streams, I suspect that's well worth considering. There are probably, as Sam pointed out, a lot of detailed considerations about how you would take up the person's entitlement in the next fund, what their opening balance was, if there's an indeterminate asset base, or if the paying fund is guaranteeing a particular amount, the time period over which that amount would be paid. I think in general, anything that can be done to make the system more robust is worth exploring. That particular issue where you have transactions, delayed transactions between funds, I suspect has a fair amount of complexity that would need to be worked through. Yeah.
Well, ladies and gentlemen, would you join me please in thanking our panellists?